When you think of investing legends, one name pretty much always leaps to mind, right? Warren Buffett.
Absolutely. His unparalleled success and, the whole investing philosophy he champions building on those titans, Benjamin Graham and David Dodd, it's fundamentally reshaped how generations of us approach the markets.
Totally. Their core belief, finding genuinely undervalued securities through rigorous fundamental analysis, it just feels like solid ground. Common sense almost in a world often swayed by, well, fleeting trends.
It does. But here's where it gets truly fascinating and where the financial world has seen this persistent, perplexing tension for decades.
Yeah. What's that?
Well, for as long as many of us have been in this field, the powerful idea that you can consistently beat the market by uncovering these undervalued gems, which is, the very essence of Graham and Dodd's approach, it's found itself in direct philosophical conflict with a cornerstone of modern financial theory.
The efficient market hypothesis.
Precisely. The EMH, in its strongest forms, suggests that basically all publicly available information is already reflected in stock prices.
Making it virtually impossible for anyone to consistently achieve, like, abnormal returns through fundamental analysis alone.
Exactly. It's a deep fundamental divide.
Yeah.
You've got the apparent, undeniable success of practitioners like Buffett on one side, and then this academic skepticism about the very possibility of that success on the other. How can both be true?
And that, my friends, is exactly what we're going to dive deep into today. Our mission in this deep dive is to explore some really groundbreaking research that daringly aims to bridge this very gap.
Trying to build a bridge between Graham and Dodd and efficient markets, that's ambitious.
It is. The goal is providing an elegant equilibrium foundation for Graham and Dodd's security analysis and, crucially, reconciling it with the idea of efficient markets. We're dissecting a paper titled The Economics of Security Analysis, published in Management Science in 2024 by Hu, Mo, Zhu, and Zhang, alongside its very rich online appendix.
Okay, so Hao, Mo, Su, and Zhang, what's their approach?
We're going to unpack how their new theoretical framework, the investment CAPM, and its incredibly powerful empirical implementation, the Q5 model, offers a compelling and honestly surprisingly intuitive bridge.
The investment CAPM and the Q5 model. Got it.
By the end of this deep dive, you're going to get a shortcut to understanding what's truly driving not just the returns of quantitative trading strategies, but also the astonishing, almost mythical success of top active managers, including, yes, the legendary Warren Buffett himself. You're about to see the financial world through a new, clearer lens. Okay, let's unpack this then. Before we dive into how modern finance is sort of making sense of it all now, we really need to go back to the roots, to the origins of this whole debate.
Back to Graham and Dodd.
Exactly. The cornerstone of investing for countless individuals and institutions really began with Benjamin Graham and David Dodd. Their monumental 1934 book, Security Analysis, and, its later editions, laid out a philosophy that still resonates so strongly today.
The profound idea of buying undervalued securities.
Right. Essentially, stocks selling for less than their true or intrinsic value. This wasn't about following the herd or chasing hot tips, was it?
Not at all. It was about painstaking research, peering deeply into a company's financial health, its prospects. Graham and Dodd, specifically in their 1940 edition, they articulated that security analysis is fundamentally, quote, concerned with the intrinsic value of the security, and more particularly with the discovery of discrepancies between the intrinsic value and the market price.
Discrepancies, that's the key word.
It is. And they went on to explain that this intrinsic value is, and I'm quoting loosely here, justified by the facts, things like assets, earnings, dividends, definite prospects, as distinct from market quotes that might be, artificially manipulated or distorted by psychological excesses.
So a call to rational, fact-based assessment. Focus on what's real and tangible about the business, not just the stock price ticker.
Absolutely. And it's crucial to understand when Graham and Dodd talked about intrinsic value, they weren't suggesting analysts could magically pinpoint an exact, precise dollar figure. They were far too pragmatic for that.
Right. They weren't claiming perfect foresight.
No. Their objective was much more about establishing a range, getting a clear sense of whether that intrinsic value was considerably higher or considerably lower than the market price.
Okay, so like knowing if a house is worth significantly more or less than the asking price without needing the exact cent.
That's a great analogy. Exactly. This distinction is vital because it wasn't about perfection, but about identifying a clear material discrepancy, something that indicated a significant opportunity or, conversely, a substantial risk. It was about creating that margin of safety.
Ah, the margin of safety, that famous buffer.
Yes, that buffer that protects against, well, human error or unforeseen events, making sure that even if your valuation was slightly off, you were still likely to be on solid ground.
That brings us to one of Benjamin Graham's most brilliant analogies, right? The concept of Mr. Market from The Intelligent Investor.
Ah, yes, Mr. Market. Classic.
Graham painted this picture of this whimsical, almost bipolar business partner who shows up every single day offering to either buy your shares or sell you more.
And crucially, Mr. Market's mood swings wildly.
Right. Some days, Graham says, his enthusiasm or his fears run so far away from him that the price he proposes seems, quote, a little short of silly.
It's such a powerful analogy. It emphasizes their view of the market as primarily a voting machine in the short term, driven by collective emotions, by fleeting fear, by irrational exuberance.
But, and this is key, Graham and Dodd firmly believe that in the long run, the market would behave more like a waiting machine.
Eventually, inevitably, reflecting the true underlying business value, weighing the facts.
It's an incredibly powerful visual for any investor, isn't it? Encouraging you to look beyond the daily noise and that emotional roller coaster.
And the practical impact of this whole philosophy, well, it simply cannot be overstated. It didn't just change how people thought about investing. It quite literally laid the groundwork for and helped professionalize the entire financial analysis profession.
You see its enduring legacy everywhere.
Absolutely. In the incredible success of countless investors who've diligently followed in their footsteps, most famously, of course, Warren Buffett, but also brilliant minds like Joel Greenblatt, Seth Klarman, Bill Miller, Charlie Munger.
Their philosophy, centered on diligent research and rational assessment. It really forms the bedrock of what we now call value investing and continues to guide huge swaths of the asset management industry globally.
No question, a massive enduring impact.
Okay, so given that deep and frankly undeniable impact on how people actually make investment decisions, it's truly fascinating to see how the academic world has, grappled with Graham and Dodd's ideas over the decades.
It's been a real split, hasn't it?
It really has. On one hand, you have the fundamental analysis literature within accounting, which has, for the most part, heartily embraced this perspective. They genuinely see intrinsic values meticulously derived from financial statements as absolutely vital benchmarks for identifying stocks that are truly mispriced.
Like forensic accounting, almost. Digging deep to find the financial truth.
Exactly. You had O. N. Penman, way back in 1989, explicitly stating that intrinsic values discovered from financial statements serve as benchmarks with which prices are compared to identify overpriced and underpriced stocks. Pretty clear.
And Penman, in his influential 2013 textbook, put it even more starkly. He said fundamental investors actively challenge the market price. Is it indeed a fair price?
Right. And more recently, Bartram and Greenblatt, in their 2018 work, they largely attributed the profits that you can get from fundamental analysis to a behavioral story about mispricing, basically suggesting these discrepancies pop up because of psychological biases in the market.
So within the accounting discipline, there's the strong, consistent belief that these mispricings are not only real, but also quite exploitable.
But then you pivot to traditional academic finance.
And it's a completely different story. This is where the plot thickens, and it raises that important question for you, the listener. If these mispricings are so evident and actionable to fundamental analysts, why has traditional academic finance for so long largely dismissed them?
Enter the efficient market hypothesis, the EMH championed by Eugene Fama back in 1970, and the classic capital asset pricing model, or CAPM.
Right. This dominant view in traditional finance has historically characterized any observed profits from security analysis as being purely from luck, just noise.
And consequently, it often recommends a strategy of passive investing, basically arguing that actively trying to beat the market is, a fool's errand.
Leading textbooks, like Bodie et al., reinforce this. They basically say, if the analyst relies on publicly available earnings and industry information, his or her evaluation of the firm's prospects is not likely to be significantly more accurate than those of rival analysts.
The clear implication being, if you're only using publicly available data, the very foundation of fundamental analysis, you're not going to gain any lasting edge. Everyone has that info.
Exactly. And this deep-seated, long-held belief system is precisely what the groundbreaking research we're discussing today aims to fundamentally challenge, or perhaps more accurately, to profoundly reframe.
Trying to bridge that chasm, right? Offering a new perspective that maybe honors both the success of Graham and Dodd and the logic of efficient markets. Can it be done?
That's the multi-billion-dollar question, isn't it?
Okay, here's where it gets really interesting and where this paper, Hu, Mo, Xu, and Zhang, delivers its first major aha moment. They introduce what's called the investment CAPM.
The investment CAPM, okay.
And it offers a radically different, yet I found, profoundly intuitive way to think about how security analysis actually works. The core innovation here isn't just a tweak. It's a fundamental shift in perspective.
How so?
Instead of solely pricing securities from the perspective of investors, like traditional models such as the CAPM do, the investment CAPM boldly prices them from the perspective of their issuers.
The issuers, you mean the firms themselves?
Exactly. From the viewpoint of the firms making the investments. Imagine this. You're trying to understand the true value of a house. Traditional models might focus on what buyers are willing to pay, right? Influenced by market sentiment, interest rates, whatever.
Okay, the demand side.
Right. But the investment CAPM says, hold on, let's also look at it from the builder's side. What were the actual costs of the materials? What was the labor involved? What are the expected profits from building that house?
Ah, the supply side. Focusing on the economics of the company making the decisions, that is a shift. It builds on some foundational work by Cochrane and Zhang, doesn't it?
It does. Deep roots there.
And this shift in perspective, it connects directly to a foundational, almost sacred concept in corporate finance, the net present value, or NTV, rule.
Right. Firms invest until the NPV of the next project is zero.
Basically, yeah. A rational firm is predicted to keep investing in new projects only as long as the net present value of its marginal project is zero. If a project has a positive NPV, do it. If negative, reject it. And this economic principle is absolutely key to the investment CAPM.
So how does that link to stock prices?
Well, the model then predicts that a firm's discount rate, essentially its cost of capital, or, the expected return investors demand from it, should precisely equal the incremental benefit of its marginal project divided by its incremental cost.
Benefit divided by cost. Okay.
It's a highly logical, deeply economic, and fundamentally supply-side driven approach to valuing a business. It's about how much return a firm needs to generate to justify its investments.
And from this elegant economic logic, we get these incredibly powerful intuitive predictors for what actually drives higher expected returns. What are those benefits and costs?
Well, the model identifies the incremental benefit with what we can call quality metrics. Things like a firm's expected profitability and its expected growth, the good stuff that comes from investing.
Makes sense. Profitability and growth.
Then, the incremental cost of investment is closely tied to Tobin's Q.
Tobin's Q, that's the market value relative to the replacement cost of assets, right?
Exactly. Think of it as comparing what the market currently values a company at to what it would cost you to rebuild that company's entire asset base from scratch today.
Okay, so what does a low Tobin's Q mean here?
If a firm has a low Tobin's Q, it suggests its market value is low relative to the cost of its existing assets. In this context, a low Tobin's Q implies bargain prices. The market isn't fully valuing the assets already in place or maybe the new investments the firm is making.
So high-quality metrics like profitability and growth divided by a low-cost metric like Tobin's Q, that means a higher expected return.
Precisely. So what the investment CAPM essentially tells us, derived purely from these economic principles, is that to earn high expected returns, investors should seek out and buy high-quality stocks at bargain prices.
Wait a minute. Buy high-quality stocks at bargain prices? That sounds incredibly familiar.
It should. It's exactly in line with Graham and Dodd's core philosophy. But here's the absolute game-changing part. The investment CAPM gets there without resorting to the idea of market mispricing.
How? If it's a bargain price, isn't that mispricing?
Not in this framework. Instead of saying the market is wrong or irrational about these stocks, this model says those undervalued or high quality at bargain price stocks aren't mispriced in an inefficient sense. They just have higher equilibrium expected returns built into their fundamentals because of these specific measurable economic forces related to investment and profitability.
Whoa. Okay, so the higher return isn't because the market made a mistake that we'll correct, but because the stock's fundamental economics justify a higher expected return going forward.
Exactly. It's a complete reframe. It potentially brings value investing into the fold of efficient markets, explaining why those characteristics lead to higher returns in equilibrium.
That's huge. So it's not about market irrationality, but about equilibrium compensation for certain economic characteristics.
This is a critical distinction and one for you, the listener, to really internalize. Graham and Dodd, by implicitly assuming a relatively constant discount rate across stocks, had to attribute any observed return predictability directly to market mispricing, the market just getting the price wrong. Their genius in that view was finding that truth before others.
Okay, that makes sense as their starting point.
But the investment CAPM offers a fundamentally different explanation. It provides a robust economic model for cross-sectionally varying expected returns, different stocks having different expected returns within the framework of efficient markets.
So predictability exists, but it's not abnormal in the sense of inefficiency.
Right. Predictability exists, but these are not abnormal returns in the sense that passive investing proponents would dismiss. Rather, they are simply the deserved expected returns an investor should demand for holding stocks with particular, identifiable fundamental characteristics. Characteristics related to their investment opportunities, their profitability, their growth prospects.
So this raises that important question again. Are investors just finding temporary mispricings that eventually correct? Or are they consistently identifying fundamental economic characteristics that deserve a higher return in equilibrium?
And this paper strongly argues for the latter. It's trying to finally bring security analysis into clear, coherent alignment with the logic of efficient markets.
It's truly like discovering the missing piece of a centuries-old puzzle, isn't it?
Mm-hmm.
This research even directly addresses what Warren Buffett, way back in 1984, famously called the unfortunate dichotomy.
Yeah, the split between demand-focused modern finance like the CAPM with its betas and investor behavior focus, and the supply-focused approach of traditional security analysis.
Exactly. And this new framework fundamentally suggests these aren't opposing forces that contradict each other, but rather two sides of the same coin.
We don't need to choose.
Apparently not. We need both the demand side and the supply side to fully grasp equilibrium asset pricing.
That makes a lot of sense. Think of it this way. The traditional CAPM, from the investor's perspective, tells us about the demand for assets and how risk shapes those demands.
Okay.
The investment CAPM, sort of symmetrical to that, focuses on the firms supplying those assets, modeling their investment decisions, and the expected returns they must offer to justify those investments. One models betas from the investor side, the other models characteristics from the firm's side.
Both crucial for a complete picture.
Absolutely. Both are crucial for a holistic understanding of market dynamics and asset pricing. And the core argument here is that the investment CAPM, because it's so deeply grounded in the underlying economics of the firm's operations and investment decisions, potentially yields more reliable and economically intuitive expected return estimates. It's a powerful new lens.
Okay, theory is great. But how do we take this powerful new theory, the investment CAPM, and actually test it in the complex, messy, real world of stock markets?
Right, the empirical evidence. This is where the Q5 model comes into play.
The Q5 model. This is the practical implementation.
Exactly. It's the practical empirical implementation of the investment CAPM meticulously developed by Hu, Zhou, and Zhang and their colleagues in papers around 2019 and 2021. This model includes 5 specific factors, or broad drivers, designed to capture the economic forces we've just been discussing.
Okay, let's break them down. What are the 5 Q factors?
All right, first, no surprise, you have the market MKD factor. That captures the overall market risk, the broad movements of the stock market as a whole. Standard stuff.
Got it. Market risk.
Second, the size May factor. This distinguishes between small and large firms based on their market equity, reflecting the well-known size premium, where smaller companies have historically tended to outperform larger ones.
Okay, size. Also familiar.
Third, the investment IA factor. Now, this is core to the investment CAPM. It identifies that firms with relatively low investment, specifically measured as slower growth of total assets, tend to have higher expected returns.
Low investment, higher returns. Counterintuitive maybe, but linked to that bargain price idea. Efficient capital use.
Precisely, linked to Tobin's Q and avoiding wasteful investment. Fourth, the return on equity ROE factor. This indicates that highly profitable firms, those generating strong returns on their shareholders' equity, tend to deliver higher expected returns. This captures the quality aspect.
Profitability. Makes sense. High quality.
And finally, fifth, the expected growth 8 factor. This suggests that firms with high expected future investment growth anticipating significant expansion and development also tend to have higher expected returns. This captures another facet of quality and future potential.
Okay, so market, size, investment, low is good. Row, high is good. And expected growth, high is good. That's the Q5.
That's the Q5 framework. And these factors aren't just theoretical constructs, they're rigorously tested against real-world data.
Where does the data come from?
The inputs are sourced from comprehensive financial databases like CRSP for market data and CompuStat for accounting data, using both annual and quarterly fundamental files. This robust data foundation allows for an extensive sample period, typically running from January 1967 all the way through December 2020 for most of the analyses in the paper.
Wow, over 50 years of data.
Yeah, a really substantial data set. It's crucial because it allows for robust, statistically powerful empirical testing. They can examine how these 5 factors explain observed returns across a very wide range of investing strategies and market conditions over more than 5 decades. This isn't just a fleeting observation. It's looking at deep, long-term phenomena.
So what does this all mean for you, the listener, the investor, the curious learner? It means we now have this incredibly powerful and, I think, intuitive framework, the Q5 model, that can systematically break down and tell us what really drives the returns of these seemingly disparate investing strategies.
Moving beyond anecdotes and subjective theories.
It's exactly. Moving to hard numbers and deep economic insights. It's an ability to analyze historical performance with a new, more comprehensive, and economically grounded lens. It's truly a potential game changer for understanding investment success. All right, now that we've got the deep economic logic behind the investment CAPM and its empirical powerhouse, the Q5 model, let's really put it to the test. Let's see how it decodes some of the most well-known and, often praised quantitative security analysis strategies out there.
The rubber meets the road.
Exactly. And first, just a quick practical point for our discussion. When we talk about a high minus low decile or quintile spread in these strategies, what are we actually describing?
Right, good point. Typically, it means a portfolio that buys the stocks that score highest on a particular metric, say the top 10% or 20% of companies based on that signal, and simultaneously sell short the stocks that score lowest on that metric, the bottom 10% or 20%.
So it's a long-short portfolio. Why do that?
It isolates the premium or the additional return specifically associated with that characteristic. It cancels out broad market movements and magnifies the effect of the strategy itself. It's a standard way to measure the power of a specific signal.
Okay, got it. So let's start with the fundamental strategy developed by Abarbanel and Bushy back in 1998. This one seems pretty comprehensive.
It is. It combines 7 distinct fundamental signals drawn directly from financial statements. Things ranging from changes in inventory and accounts receivable to capital expenditure intensity, gross margins, even selling expenses and labor force efficiency.
Wow, 7 signals. What was the goal?
The goal was to aggregate these signals to try and forecast future stock returns. So yeah, a fairly complex, multifaceted approach to fundamental analysis. And historically, this strategy certainly showed observable performance. Over that long period, 1967 to 2020, a portfolio buying the highest scoring decile and shorting the lowest based on these signals generated an average return of about 0.29% per month.
It was that significant, like not just random.
Yes, it was reliably statistically significant. T2.42. It wasn't just noise. There seemed to be a real repeatable pattern there. And when they further sorted stocks by size micro, small, big, green, the strategy continued to deliver positive returns across the board, suggesting its effectiveness wasn't just confined to tiny stocks or something.
Okay, so for decades, investors looked at that and probably thought, these analysts are finding true mispricings, maybe exploiting investor underreaction to earnings news or something like that. But what does the Q5 model reveal is really going on under the hood?
Well, the Q5 model largely demystifies this performance. For that overall high minus low decile, the portion of the return unexplained by the Q5 factors, what we call the Q5 alpha, was significantly reduced. It became much smaller and critically statistically insignificant, alpha of 0.13% to 0.85.
So the Q5 factors basically accounted for the return.
The bulk of it, yes. It tells us that most of the observed return wasn't some mysterious alpha, but compensation for bearing the risks captured by the Q5 factors.
Which factor was the main driver here?
The key driver, identified by the Q5 model, was a strong positive influence from their return on equity rho factor. It had a significant loading, 0.26 T2.93.
That makes sense given the signals involved.
Right. The strategy's emphasis on things like gross margin and labor force efficiency directly aligns with and captures strong expected profitability, which the Rho factor is designed to measure. So while the strategy's original interpretation might have leaned towards investor underreaction, the Q5 model peels back the layers. It shows the primary engine driving these returns was actually the fundamental economic characteristic of strong expected profitability within these firms. A lesser role was played by the expected growth factor, too.
That's a fascinating reinterpretation. It's a great example of taking a strategy that seemed complex, with 7 signals, and simplifying its core economic driver down to 1, maybe 2 of the Q5 factors, mainly expected profitability here. Okay, let's move on. How about Frankel and Lee's 1998 intrinsic to market ratio strategy? This one seems very direct in its goal.
It is. It estimates a firm's intrinsic value using a fairly standard 2-period residual income model, a common valuation technique. Then it uses the ratio of this estimated intrinsic value to the current market price to forecast future returns.
So a direct attempt to identify stocks that appear cheap relative to their calculated fundamental worth. Find the bargains.
Exactly. And empirically, this strategy also showed predictive power. While the overall high minus low decile had a modest average return, 0.23% per month, TP 1.29, the predictability became stronger when looking at quintiles. The average high minus low quintile return was 0.36% per month, which was statistically reliable, T2.38.
And did this hold up across different company sizes?
Yes, this premium showed consistency across micro, small, and big stocks, suggesting it wasn't just a small cap phenomenon.
Okay, so it seemed to predict returns, suggesting a discrepancy between intrinsic and market values was being found. But how much of that was truly unexplained alpha according to our Q5 model? What's the economic reality behind this perceived mispricing?
Well, the Q5 model, again, significantly reduced the unexplained portion of these returns. For the high minus low quintiles across different size groups, the Q5 alphas became statistically insignificant, ranging from 0.11% to 0.20% with T-stats below 1.7.
So again, the Q5 factors accounted for most of it. Which one was key this time?
What's truly fascinating here is that the investment factor was identified as the overwhelming key driving force. It showed large and highly significant positive loadings, ranging from 0.54 to 0.73 across size sorts.
The investment factor, not profitability.
Primarily investment here. This suggests that even when a strategy appears to find mispricing by directly comparing intrinsic to market values, the underlying economic engine driving those returns isn't some market error, but rather the fundamental dynamics captured by the investment factor.
How does that work? How does intrinsic value link to investment?
The paper makes a powerful argument. Even if intrinsic value perfectly equals market value, meaning zero actual mispricing, the estimated intrinsic to market ratio would still predict returns. Why? Because the way it's calculated makes it act as a nonlinear function of investment, profitability, and expected growth. And crucially, the book-to-market component, which is inherent in many intrinsic value calculations, is profoundly linked to the investment factor itself within the investment CAPM framework.
Wow. Okay, that's a powerful reframe. What looks like a mispricing signal is actually just a proxy for fundamental economic forces, consistent with an efficient market. Okay, next up, a perennial favorite, one that promised an easy path, maybe. Joel Greenblatt's widely publicized magic formula from his books.
Yes, the magic formula. Very popular.
His simple yet apparently effective strategy is famously summarized as buy good companies, those with high returns on capital, at bargain prices, those with high earnings yields. It elegantly combines a profitability metric with a value metric.
And for many, the formula certainly seemed to deliver. Historically, the high minus low decile based on the magic formula generated substantial and statistically significant returns, averaging around 0.57% per month, T2.54.
That's pretty good. Across different sizes, too.
Yes, across various size categories, from micro to large cap stocks, the high minus low quintile consistently generated impressive monthly returns, around 0.35% to 0.41%. It certainly appeared to work like magic for many who followed it.
But the Q5 model steps in to reveal the mechanics behind this magic. How much of that performance was truly unexplained alpha?
Well, you guessed it, the Q5 model largely demystified this magic. The Q5 alphas for these strategies were significantly reduced, often becoming statistically insignificant, ranging from Madigan 0.13% to 0.06% across size groups.
So the magic wasn't magic.
It powerfully demonstrates that the magic wasn't some elusive secret, but rather the systematic exposure to the fundamental economic factors embedded within the Q5 model.
Which factors were driving it? Quality and value, so maybe Rho and investment?
Exactly right. The primary driver in this case was a consistently large and highly significant positive influence from the return on equity rho factor. The loadings were very strong. 0.67 for micro, 0.59 for small, 0.42 for big stocks, all highly significant. This makes perfect sense, as Greenblatt's return on capital metric is inherently and closely related to a firm's return on equity.
And the value part, the earnings yield.
The earnings yield, as a value metric, also connects directly to the investment factor, illustrating again that profound investment value linkage within the investment CAPM framework. So while it performed exceptionally well, the underlying economic forces of profitability and disciplined investment captured by the Q5 model were doing the heavy lifting, not some market inefficiency.
Joel Greenblatt promised a magic formula that beats the market. And while it certainly performed well historically, our deep dive reveals the magic isn't some secret behavioral trick, but rather the powerful role of identifiable fundamental profitability and efficient investment. Okay, moving on, we have the quality minus junk strategy by Asness and his colleagues from 2019.
Right, AQR's QMJ. This strategy attempts to define quality more broadly, combining metrics related to profitability, growth, and safety. The argument is that rational investors should be willing to pay a premium price for these high-quality characteristics.
And the hypothesis was that these high-quality stocks should, in turn, earn higher average returns than lower quality or junk stocks, did they?
Well, the overall high minus low decile for quality minus junk earned a modest 0.28% per month, but it wasn't consistently statistically significant across all samples, T1.43. Interestingly, the premium seemed to vary inversely with size. It was more pronounced for smaller companies, 0.55% for micro, than larger ones, 0.22% for big.
So a bit more nuanced. How did the Q5 model account for this quality premium? What did it uncover about the true nature of these quality returns?
The Q5 model significantly dampened this premium. The overall decile alpha dropped to a tiny 0.02%, T0.15, completely insignificant. For the two-way sorts across size, the Q5 alphas also became mostly small and insignificant, 0.08% for small, 0.04% for big, with the exception of microcaps, where some alphas still seem to remain.
They're 0.27%, TO 2.02.
Okay, mostly explained. But you mentioned nuance. What was interesting about the factor loadings here?
This is where it gets really fascinating. It highlights the model's ability to disentangle complex interactions. Quality minus junk actually had significantly negative loadings on the market, size, and investment factors.
Negative. That seems counterintuitive. Why would a quality strategy load negatively on investment, for instance? Wouldn't quality firms invest?
It seems odd at first glance, right? Why would a quality strategy move in the opposite direction of what you might expect from these factors? However, it also exhibited significantly positive loadings on the row, profitability, and expected growth factors.
So the positive loadings on profitability and growth were fighting the negative ones. Exactly. These latter two factors, which capture perhaps the truer underlying quality dimensions of a firm in this context, were powerful enough to overcome the negative impact of the first three. Ultimately, the model explains the premium through the lens of strong expected profitability and growth, not just by avoiding junk as some simple market phenomenon.
So it points to a sophisticated interplay of various fundamental characteristics that the Q5 model can meticulously disentangle. Quality isn't a monolithic concept. It's a combination of drivers, some pulling in different directions.
Precisely. The paper also looked at an alternative quality score that included payout yield and that showed stronger predictive power and was also well explained by Q5, again with rho, and expected growth being key.
That's a deep insight. What we perceive as quality isn't just one simple thing. Okay, next, let's examine Bartram and Greenblatt's 2018 agnostic strategy. This one sounds intriguing.
It is quite clever and, true to its name, rather neutral in its approach. It uses a mispricing measure derived from the percentage deviation of a firm's peer-implied intrinsic value from its actual market equity.
Peer-implied intrinsic value. How do they calculate that?
Essentially, they calculate this intrinsic value by regressing market equity on a long list of accounting variables from similar companies within the same industry. It's agnostic because it doesn't presuppose a specific dogmatic valuation model like residual income or DCF. It lets the data from peers dictate the expected value.
Okay, clever. How did this agnostic approach perform?
It proved to be quite effective. From 1977 to 2020, the high minus low decile earned a reliable average return of 0.39% per month, T2.22. And across different size categories, it showed even stronger performance for microcap stocks, 0.81%, demonstrating robustness.
So this strategy seemed to identify stocks that were mispriced relative to their peers without taking a strong stand on why. But what did the Q5 model reveal about the true economic drivers?
Once again, the Q5 model stepped in to largely explain these returns. It reduced these average returns to statistical insignificance for most categories. For example, even for the strong microcap return, the Q5 alpha, while positive at 0.42%, lost its statistical reliability, T1.62.
And the key driver this time, was it profitability again? Or something else?
The investment factor played a remarkably significant role here, showing a strong positive loading, 0.57 to equal 3.76.
Investment again.
Yes. This demonstrates that similar to Frankel and Lee's approach, which also tried to estimate intrinsic value, this agnostic strategy, despite its neutral name, is ultimately viewed through the investment CAPM lens as a form of value investing. Its returns are predominantly driven by the fundamental economic force of efficient investment.
It underscores how even when a strategy doesn't explicitly search for value or growth, the underlying economic factors identified by the investment CAPM are often the true engines of its performance. Truly eye-opening.
It really is. It shows the power of that investment factor.
Okay, now this next strategy offers, I think, a powerful aha moment, especially for anyone grappling with the evolving nature of value investing. It's the operating cash flow to market strategy.
Yes. Inspired by Ball's work way back in 1978, but highly relevant today.
This approach uses a firm's operating cash flow, scaled by its market equity, as a value indicator. Crucially, it moves beyond the traditional and arguably less relevant in some sectors book-to-market ratio.
And this strategy demonstrated truly compelling predictive power. The high minus low decile generated a remarkably strong average return of 0.79% per month.
Wow, almost 0.8% a month. Was that significant?
Highly statistically significant, TQA 3.73. It signals a very reliable and robust premium, and the superior performance was consistent across all size categories, micro, small, and big, again showing its broad applicability. This isn't just a slight edge, it's a very significant observable return historically.
That's incredibly compelling. So how did the Q5 model break down this potent return source? And what did it tell us about why it might be so much more effective than traditional book-to-market?
The Q5 model significantly reduced the unexplained portion of these returns. The overall decile's Q5 alpha dropped to a much smaller 0.15%, which was statistically insignificant, T 0.92. And the model largely explained the performance across the quintile spreads as well, especially for larger stocks where the alpha went near zero.
Okay, mostly explained again. Which factor was the powerhouse here? Given the cash flow nature, maybe profitability, or still investment?
The overwhelming key driver here was the investment factor. It showed economically large and highly statistically significant positive loadings, ranging from 0.79 to 1.14 across size sorts.
Investment again, even for a cash flow metric.
Yes. This is a very powerful finding for a couple of reasons. Firstly, it strongly suggests that operating cash flow to market is indeed a superior value indicator compared to the traditional book-to-market ratio. The paper highlights that the traditional high minus low book-to-market decile, by contrast, only earned a modest and statistically insignificant 0.3% per month, T1.45 over the same period.
Echoing those discussions about a possibly disappearing value premium when measured traditionally.
Exactly. This finding supports that view. But secondly, it offers a crucial insight, echoing Stephen Penman's work, that missing intangibles from the balance sheet might not necessarily be deficient because their value can be ascertained from the flow variables in the income statement.
So cash flow captures more of the modern economy, including intangibles, better than book value.
That seems to be the implication. It's about looking at the full picture of a company's economic activity and value generation, not just what accountants traditionally put on the balance sheet. And the Q5 model tells us this superior value metric is strongly linked to the investment factor.
This is a truly profound aha moment. Classic book-to-market might be losing its edge, but a more comprehensive flow-based measure of value, rooted in cash flow, is still incredibly powerful. And the Q5 model tells us why it's tied to the economics of investment.
Amazing. Okay, almost through the quant strategies. How about Penman and Zhu's 2014-2020 expected return strategy, ER8? This sounds sophisticated. It is. This approach constructs an expected return proxy, ER8, by projecting future returns onto 8 specific anomaly variables. These variables are carefully selected because they are theoretically connected to future earnings growth and financial health.
What kind of variables?
Things like earnings to price, book to market, accruals, investment levels, growth in net operating assets, return on assets, net external financing, and net share issues. It's a holistic attempt to predict future returns from a range of fundamental signals that should indicate future performance.
How did this comprehensive ER8 strategy perform, and what deeper truths did the Q5 model reveal?
From 1982 to 2020, the high minus low decile based on ER8 earned a very strong and statistically reliable average return of 0.74% per month, T4.21. The premium varied inversely with size, again showing robustness.
Another strong performer. Did Q5 explain it?
The Q5 model did an excellent job explaining a significant portion of this performance. It reduced the decile's Q5 alpha to 0.36%. While still statistically significant, T2.12 min, it's a big reduction. For small and big stocks specifically, the Q5 model rendered the quintile spread statistically insignificant.
And the key drivers identified this time, given the focus on future earnings growth, expected growth factor.
Exactly. The key drivers were substantial positive influences from both the investment factor, loading 0.56 T equal 5555, and the expected growth factor, loading 0.51 T 4.59.
How do they both fit?
While ER8's value metrics, like book to market, naturally correlate negatively with investment, meaning high value correlates with low investment, linking it to the investment factor. And its strong focus on predicting earnings growth, which often correlates with future investment growth, links it directly to the expected growth factor.
That's truly fascinating. So this sophisticated strategy built on a wide array of anomaly variables aimed at predicting returns, it's ultimately tapping into the same fundamental economic drivers, investment and expected growth, that the investment CAPM identifies.
Indeed. And here's another interesting theoretical point highlighted in the paper. The investment CAPM is seen as potentially even more fundamental than Penman and Zhu's model.
How so?
Because the investment CAPM can effectively substitute market equity out of its formulation, directly linking expected returns purely to fundamental investment and profitability measures from the firm's perspective. Penman-Zhu's model still retains market equity within its construction. This deeper, more direct linkage to fundamental economic decisions arguably strengthens the investment CAPM's claim as a truly fundamental economic model for expected returns.
Wow. It demonstrates how strategies designed to predict future returns, no matter how intricate, often converge on these core economic drivers, highlighting the model's profound robustness. Okay, finally, let's briefly touch on Piotrowski's 2000 fundamental score, the F-score. This is mentioned in the online appendix.
Right, the F-score. Also quite intricate. It distills a firm's financial health into a single number by combining 9 fundamental signals across 3 categories: profitability, liquidity, and operating efficiency. Each signal is binary 1 or 0, creating a composite health score from 0 to 9.
How did the F-score perform, and what did Q5 say?
The overall high minus low decile for the S-score earned a more modest and statistically insignificant 0.2% per month, T0.8, from 1972-2020. However, the spreads within quintiles across different size categories were more notable and robust, around 0.2% to 0.36%. This suggests its power was more apparent when making finer distinctions within the market.
And the Q5 explanation.
The Q5 model again largely explained this predictability. The Q5 alphas for the quintile spreads became statistically insignificant across most categories. Alphas from 0.04% to 0.28%, mostly low T-stats.
And the key driver for Piotrowski's F-score, it focuses on financial health, so maybe profitability.
You got it. The rho factor emerged as the predominant key driving force, with substantial positive loadings. 0.62 for micro, 0.47 for small, 0.4 for big. This makes perfect intuitive sense, as many of Piotrowski's signals, particularly those related to profitability and operating efficiency, directly relate to a firm's return on equity. The investment factor also played a smaller role for micro and small stocks, due to its connection with an equity issuance indicator in the score.
So even a seemingly complex, multifaceted score like Piotrowski's, distilling financial health into one number, ultimately boils down to a few core economic concepts like profitability and efficient investment, as revealed by the Q5 model.
That's the consistent story, yes.
Okay, we spent a good deal of time demonstrating how the Q5 model decodes and, frankly, demystifies these complex quantitative strategies. But now for perhaps the ultimate challenge, right? The holy grail of investing. What about the elite active managers?
The stars, the ones who claim to exploit unquantifiable qualitative information, the insights maybe no algorithm could ever capture.
Exactly. This research really set a very high hurdle for the Q5 model by rigorously examining the performance of some of the best performing, truly discretionary equity funds out there.
How did they select these best funds? That's always tricky.
Good question. They meticulously selected the top 20 active equity funds from the extensive CRSP mutual fund database, covering that long period from January 1967 to December 2020. And these weren't just any funds. They were chosen based on their full life information ratios.
Risk-adjusted return, alpha divided by tracking error, essentially.
Right, a measure of their alpha relative to their residual volatility from a CAPM regression. And critically, each fund required a minimum 10-year track record.
Okay, so that filters out flash-in-the-pan luck. They were looking at truly exceptional, sustained performers.
Exactly, not just average funds that might have gotten lucky for a few years. But before we zoom in on these superstars, what did the aggregate data for all active equity funds tell us, just to set the baseline?
Right, the baseline. Well, the picture for aggregate active management, frankly, isn't particularly pretty, and it largely confirms what many, many studies have shown over the years. If you look at all active equity funds, equal weighted and before fees, they earned a modest 0.62% per month on average.
Okay, slightly above zero. But what about alpha?
Their CAPM alpha, the return unexplained by just market risk, was a mere 0.03% per month, T 0.66, statistically indistinguishable from zero, meaning they barely beat the market before accounting for their fees.
And after fees, especially considering bigger funds might charge less, but also be harder to outperform with.
When you then weight them by their total net assets, TNA, and look at returns net of fees, what investors actually get, they actually underperform the market. They had a statistically significant negative CAPM alpha of negative 0.1% per month. T2's 2.91.
Ouch. So the average active fund, after fee, is lost to the market.
That largely reinforces the uncomfortable truth of the zero-sum game idea in active management. Before costs, it's zero-sum relative to the market. After costs, it's negative sum on average. For every winner, there has to be a loser, and fees eat into the total pie.
Okay, so if the average fund manager struggles to even keep pace, how in the world do the Buffetts of the world do it? This is where the performance of those hand-picked top 20 funds becomes absolutely fascinating. What did the Q5 model reveal about their secret sauce?
Right. For these truly elite top 20 funds, let's look at them aggregated as an equal-weighted portfolio before fees. They generated an impressive average return of 1.08% per month, T equals 6.25. That's significantly better than the average fund.
And their CAPM alpha.
Was it real skill according to the old model?
Yes, they yielded a robust CAPM alpha of 0.62% per month, T6.53. Clearly significant outperformance by that measure. But here's the
Here comes the Q5 explanation. The Q5 model, by accounting for its 5 fundamental factors, significantly reduced this alpha down to 0.44% per month, T4.46. That's a substantial 59.3% reduction from their average excess return, the return above the risk-free rate.
Wow, almost 60% of their outperformance explained by these systematic factors.
It's a powerful demonstration that a very large portion of what looks like unique skill or alpha can in fact be attributed to systematic exposure to the Q5 factors: investment, profitability, expected growth, size, and market beta.
What about after fees, using value weighting? Maybe the bigger successful funds are different.
Looking at the value-weighted top 20 funds, net of fees, so closer to investor experience, they still earned a strong 0.95% per month, T5.51, with a significant CAPM alpha of 0.52%, TP's 501. It's still impressive. But the Q5 model slashed this alpha even more dramatically, down to only 0.23%. T equal 1.92. That represents a remarkable 75.8% reduction from their average excess return.
Over 3/4 of their value-weighted net of fee outperformance is explained by Q5. That's monumental.
It really is. It strongly suggests that much of what we perceive as unique alpha among even the very best managers is, in fact, systematic exposure to these deep economic drivers identified by the investment CAPM and Q5.
So a huge, almost unbelievable chunk of their secret sauce isn't magic in the traditional alpha sense, but rather a systematic, disciplined exposure to these fundamental economic factors that the Q5 model so clearly identifies. What specific factors were these top funds consistently exposed to? What were their bets?
These top funds consistently exhibited specific fundamental tilts in their portfolios. They tended to hold portfolios skewed towards high expected growth and low investment stocks.
High expected growth and low investment. That sounds like the Q5 factors.
Exactly. Critically, they showed significantly positive loadings on the expected growth factor, for example, 0.16, T3.07 for the equal-weighted portfolio. They also had significantly positive loadings on the size factor, meaning they favored smaller, growing companies. Their investment factor loadings were also positive, though not always statistically significant.
And how does that compare to the average fund?
It stands in stark contrast. Remember, the aggregate fund portfolios, they had significantly negative investment and expected growth loading.
So the top funds are doing the opposite of the average fund on these key dimensions.
Precisely. This evidence powerfully supports that zero-sum game idea again. The truly top funds aren't just getting lucky, they are systematically outperforming by exploiting these fundamental factors, often at the expense of other, less skilled funds that are making the opposite, less advantageous trades on these dimensions.
That's a truly powerful revelation about the nature of active management skill. It might be skill in consistently identifying and holding exposure to these rewarded factors. Did the Q5 model also shed light on the performance of individual top funds? Is there still some true alpha remaining for the best of the best?
Yes, they looked at the individual funds too. While 15 out of the 20 individual top funds still showed statistically significant CAPM alphas, even after fees indicating some level of outperformance by that traditional measure, the Q5 model reduced this number dramatically. Only 7 out of the 20 had statistically significant Q5 alphas.
So Q5 explained away the significant alpha for more than half of these top performers.
That's right. For these individual funds, the Q5 alphas, the returns still unexplained by the 5 factors, ranged from essentially 0.00% up to about 0.9% per month for the very best performer after accounting for Q5.
So what's the takeaway?
It suggests that while some genuine individual alpha skill unrelated to these factors might indeed remain for a select few, a very large portion of the observed outperformance of even the absolute best active managers can be robustly attributed to their systematic and consistent exposure to the investment, profitability, and expected growth factors identified by Q5. It really reframes our understanding of what constitutes true, unique skill in active management versus skilled factor harvesting.
Okay, now for the legend himself, Warren Buffett and Berkshire Hathaway. His performance is truly legendary, almost beyond belief. An average excess return of 1.41% per month from February 1968 through December 2020. That's a T-stat of nearly 5. An incredible, sustained track record that has inspired generations. Many would just say that's pure, unadulterated genius and skill. End of story.
It absolutely is a phenomenal track record, no question. What's fascinating, though, is what the factor models reveal when applied to Berkshire Hathaway's returns. The Q-factor model, which is a slightly earlier version without the expected growth factor, was applied first.
And what did the original Q-factor model find?
It was able to reduce that extraordinary 1.41% monthly excess return down to an alpha of 0.59% per month, still positive and statistically significant, T2.34, but that represents a substantial 58.2% reduction from his raw average excess return.
Almost 60% explained by the original Q-factors. Which ones were driving that?
The models showed strong positive loadings on both the investment factor, loading 0.59, T equal 3.82, and the row profitability factor, loading 0.38, T equal 0.3.31.
Investment and row. That aligns perfectly with the common understanding of his philosophy, right?
It aligns perfectly with the widely recognized Buffett-Munger philosophy of buying profitable firms at bargain prices, essentially. Companies with high profitability and disciplined, often low investment, high row, low IA.
Okay, but that was the original Q-factor model. What happens when we apply the full Q5 model, the one that adds the expected growth factor? Does it explain even more?
Interestingly, no. The full Q5 model actually yielded a somewhat larger alpha for Berkshire Hathaway, coming in at 0.74% per month, T2.66. Still a big reduction from the raw return, but higher than the alpha from the 4-factor Q model.
Huh. Why would adding the expected growth factor increase Buffett's alpha? That seems backwards.
It seems counterintuitive at first, but it makes perfect sense when you consider Buffett's well-known investment philosophy and track record. The reason the Q5 alpha is higher is because Berkshire Hathaway had a significantly negative loading on the expected growth factor, -0.23, T equals 1.3.
A negative expected growth loading. Why would Buffett's portfolio show a negative tilt towards expected growth? He buys great businesses, don't they grow?
It reflects his consistent and deliberate reluctance to invest heavily in new, often high expected growth, high-tech stocks and sectors, especially if they come with very high valuations and high uncertainty. He famously talks about his circle of competence.
Right, staying within what he understands, often mature, steady businesses.
Exactly. His circle of competence is largely centered on mature, understandable industries with strong, consistent expected profitability and often low, efficient investment needs. Think insurance, consumer staples, railroads rather than speculative, high-growth sectors with unproven business models or technologies he feels are outside his expertise. He largely shunned the dot-com boom, for instance, preferring established businesses.
So the Q5 model penalizes him, so to speak, for not loading up on the expected growth factor, which leaves more of his return unexplained as alpha.
That's a good way to put it. Because the expected growth factor itself carries a positive premium, Berkshire's negative exposure to it means the model attributes less of Berkshire's return to that factor, leaving more room for alpha compared to the four-factor model.
Fascinating. And how does this compare to other factor models, like AQRs?
The paper notes that AQR's well-known six-factor model yields a very similar alpha, 0.58% to equal 2.07 for Berkshire over a comparable extended sample period. So different state-of-the-art factor models seem to agree that while Buffett's performance is exceptional, a very large chunk of it, maybe 50–60%, can be explained by systematic exposures to factors related to value, profitability, investment, and quality, even if the exact alpha number varies slightly depending on the specific factors included. This evidence really forces you to ask an important question again, especially for you, the learner. Is Buffett's alpha truly alpha in the purest sense skill, entirely unrelated to known systematic factors? Or is it perhaps an exceptionally focused, consistent, and disciplined application of deep economic principles related to buying profitable, low-investment companies? Principles that factor models like Q5 can now identify and quantify.
The research strongly suggests a very significant portion of his legendary success is explained by the latter, by his precise, systematic exposure to these fundamental drivers, executed with incredible discipline over decades. Still genius, perhaps, but genius of a specific factor or kind.
It certainly provides a compelling, economically grounded perspective on that legendary performance.
We've seen the incredible explanatory power of the Q5 model now, decoding both quantitative strategies and the performance of legendary investors like Buffett. But no model that relies on accounting data is perfect. There's always nuance and definitely robust debate.
Absolutely. And a major point of discussion comes from Stephen Penman and Xiaojin Zhang in their insightful 2020 and 2021 critiques. They raise a critical and very important challenge regarding how the Q and Q5 models measure investment.
Okay, what's their critique?
The traditional measure used in these models, which is basically the growth of total assets on the balance sheet, systematically excludes expensed intangible investment.
Intangibles, like R&D, advertising, employee training. Things that don't typically end up as assets on the balance sheet under traditional accounting.
Exactly. Crucial outlays for many modern companies. And here's the problem they highlight. These intangible investments often seem to forecast future returns with the positive sign, meaning higher intangible investment predicts higher future returns.
Wait, but the investment factor in Q5 says low investment predicts higher returns. That sounds like a direct contradiction.
At first glance, it really does. It seems to contradict the negative investment return relation that the investment CAPM postulates for tangible investment, like factories and equipment. How can a model truly capture a firm's investment reality if it misses this huge, increasingly vital piece of the puzzle, especially a piece that seems to behave in the opposite way?
It's like building a financial picture, but only seeing half the canvas.
Yeah.
Especially for tech or pharma or brand-driven companies.
It's a profoundly crucial point, and it lies right at the heart of many current accounting and finance debates. Penman and Zhang argue that this differential behavior, negative relation for tangible, positive for intangible, is largely due to accounting conservatism.
How does conservatism play into it?
Think about it this way. Tangible investment, like buying property, plant, and equipment, PP&E, gets booked directly to the balance sheet as an asset. It generally reflects lower risk, more certain future payoffs. You buy a machine, you know roughly what it can produce.
Okay. Less risky, shows up on the balance sheet.
In stark contrast, expensed intangible investments, those R&D dollars, those advertising campaigns, hit the income statement immediately as expenses. Why? Because their future payoffs are considered much higher risk, much more uncertain. The payoff for a new drug development or a major marketing campaign is inherently less certain than buying another factory. Accounting rules are conservative and don't let you book those uncertain future benefits as assets.
Right. So if these two types of investments have fundamentally different risk characteristics and different relationships with future returns, how can a model accurately capture a firm's overall investment if it lumps them together, or worse, completely misses the intangible part?
That's the core of their challenge. It seems like a major deficiency, especially in today's economy.
It sounds like a really strong critique. How does the Q5 model, or the paper defending it, respond to this apparent contradiction and the issue of missing intangibles?
The Q5 model's response is actually quite elegant and perhaps surprisingly largely congruent with Penman and Zhang's insights regarding the differential nature of these investments. The key isn't to ignore or miscategorize intangibles, but to treat them separately, recognizing their distinct economic characteristics within the existing factor structure.
Treat them separately. How? The investment factor only uses tangible assets, right?
Correct. The investment factor, IA, in the Q5 model is specifically built on tangible investments, meticulously measuring the growth of total assets as explicitly booked to the balance sheet. It captures that negative relationship for tangible investment.
Okay, so where do the intangibles come in?
This is the clever part. The expected growth factor in the Q5 model is ingeniously designed to incorporate the impact of intangible investments.
The expected growth factor captures intangibles.
It does this primarily by utilizing predictors that are sensitive to intangible spending. For example, one key predictor used in constructing the expected growth factor is Ball et al.'s 2016 measure of operating cash flow. And critically, this operating cash flow measure includes R&D expenses before depreciation.
So by using cash flow measures that implicitly contain R&D and potentially other intangible expenses, the expected growth factor picks up their signal.
Exactly. By using operating cash flow, the model intelligently sidesteps this intractable measurement problem of trying to perfectly separate the investment component from the expense component in broad accounting categories like selling, general, and administrative expenses, SG&A, which often contain a mix of both current expenses and future-oriented intangible investments. It's a subtle but incredibly powerful workaround.
So let me get this straight. It's not ignoring intangibles, it's treating them distinctly. Tangible investment, low is good for returns, goes into the investment factor. Intangible investment, high is good for returns, gets picked up primarily by the expected growth factor.
That's the argument. This separation is crucial because it accurately accommodates the different risks and the distinct relationships with expected returns that tangible and intangible assets appear to have, all within the spirit of conservative accounting principles that treat them differently in the first place.
So the model doesn't try to just add R&D to tangible investment to create one single total investment factor.
No, and the paper explicitly argues against doing that. They argue that simply aggregating tangible and intangible investments and their book values would destroy the accounting information on their differential risks, essentially muddling the distinct signals. Furthermore, trying to formally capitalize all intangibles on the balance sheet while theoretically appealing to some often introduces significant practical problems with estimating useful lives, amortization schedules, and impairment decisions, potentially contaminating the quality and reliability of reported earnings.
So the Q5 model's approach is presented not as a flaw, but as a carefully considered, robust methodological choice to handle the distinct nature of tangible and intangible investments using separate factors.
Exactly. This is a crucial detail for you, the learner, to grasp. The Q5 model isn't overlooking intangibles. It's designed to treat them in a way that respects their distinct economic characteristics and risk profiles, rather than attempting a simplistic and potentially misleading aggregation into a single investment measure.
And this deeper understanding of how the Q5 model handles intangibles must offer some additional clarity for interpreting the result for those strategies we discussed earlier, right?
It absolutely does. For instance, the expected growth factor, by effectively acting as an intangible investment factor, helps to partially explain the performance of the quality minus junk strategy. Remember how that loaded positively on expected growth?
Yeah.
That profitability and growth component is inherently related to cash flow generation and the impact of intangibles. And it also sheds considerable light on why the operating cash flow to market strategy is so powerful. It reveals that this strategy is essentially identifying and buying high expected growth, which often arises from substantial intangible investments at bargain prices, captured by the investment factor. This provides a richer, more complete picture of what value truly means in a modern, intangible-heavy economy compared to just book-to-market.
That makes a lot of sense. Okay, there was another critique from Penman and Zhang mentioned in the outline, this one targeting the Rho factor. What was their issue with using return on equity as the profitability measure?
Right, another significant point of contention. They argue that return on equity, ROE, is potentially a poor measure of true economic profitability. Why? For related reasons. It systematically misses intangible assets in the denominator, the E in PE, or the denominator in rho, which distorts the equity base, potentially making it look smaller than it really is economically. And it also excludes those expensed intangible investments from the numerator, the R or earnings, thereby understating true economic profit.
So missing intangibles messes up both the numerator and the denominator of rho.
That's their argument. And they point specifically to empirical data showing a negative row return relationship in annual sorts. Meaning, if you sort stocks once a year based on their last reported annual row, sometimes high row stocks underperform low row stocks.
Whoa, a negative relationship between profitability and returns. That sounds like a fundamental challenge, almost a direct refutation of the investment CAPM's core tenets about profitable firms generating higher expected returns. That would be quite a blow.
It certainly would be if that interpretation held universally. However, the Q5 model proponents offer a compelling and crucial rebuttal. The timing of the data and how frequently it's sorted matters significantly.
Timing in, like with intangibles.
Yes. The Howell paper demonstrates that this perplexing negative row return relationship is primarily prevalent only in annual sorts, which can suffer from using stale information, especially earnings data that might be many months old by the time the sort happens. Critically, when you instead utilize monthly sorts on the most recent quarterly row, the positive row return relation, precisely as postulated and predicted by the investment CAPM, dominates the empirical evidence.
Ah, so using more frequent, up-to-date quarterly earnings data fixes the problem.
It seems to. Why? Because quarterly row, by leveraging up-to-date earnings announcement data, provides a far more accurate, timely, and therefore relevant proxy of a firm's expected profitability, which is what the theory is really about. Annual row can be backward-looking and stale.
Here's another truly illuminating example for you, the listener, of how subtle details in data measurement, annual versus monthly sorts, annual versus quarterly data, can completely flip an observed statistical relationship. In this case, it validates the investment CAPM's core predictions about profitability, but only when using timely data.
It's a powerful testament to the absolute need for precision and careful methodology in financial analysis. It urges us to always consider how and when the data is being measured and used. The frequency matters.
And there you have it. We embarked on a pretty fascinating mission today, didn't we? To explore this idea of providing an elegant equilibrium foundation for Graham and Dodd's enduring security analysis.
And aiming to reconcile its profound insights with the rigorous logic of the efficient market hypothesis, no small task.
Not at all. And what we discovered is that the investment CAPM, as proposed by Hu, Mo, Zhu, and Zhang, offers precisely that kind of foundation. It predicts that expected returns vary across firms, not primarily due to ephemeral mispricings, but based on fundamental, measurable economic drivers.
Specifically, how firms choose to invest, the IA factor, their expected profitability, the rho factor, and their expected growth opportunities, the AIG factor. These are presented as the true equilibrium engines of cross-sectional returns.
And crucially, its empirical counterpart, the Q5 model, with its 5 potent factors: market, size, investment, rho, and expected growth, empirically goes a very, very long way in explaining a significant portion of what drives prominent quantitative strategies that were often previously attributed purely to mispricing or behavioral biases.
It also shed incredible demystifying light on the true source of performance for many of the world's top active managers, including the legendary Warren Buffett himself, showing how much of their success aligns with systematic exposure to these factors.
We also clarified how the Q5 model intelligently addresses those complexities and ongoing debates in accounting, particularly around tangible versus intangible investments, by treating them distinctly, using separate factors based on their differing risks and economic contributions.
Right. That separation isn't presented as a flaw in the model, but as a sophisticated design choice that arguably enhances its explanatory power by reflecting accounting realities.
So what does all of this mean for you, the listener? This deep dive fundamentally shifts the perspective, doesn't it? It shows that successful investing strategies aren't just about finding mispriced assets that the market somehow got wrong, as intuitive as that idea might feel sometimes.
While behavioral quirks and temporary mispricings can certainly create short-term opportunities, this research suggests a huge and enduring part of investment success can now be attributed to systematically identifying and exploiting underlying economic principles. Principles related to how firms invest, how they generate profits, and how they grow, even within markets that are broadly efficient in processing information.
You now have a clearer, arguably more powerful lens through which to see how a significant portion of investment success, both quantitative and active, can be attributed not just to sheer luck or simple market errors, but to understanding these deep, systematic economic drivers that models like the Q5 help us identify.
But, and this is important, this deep dive doesn't reduce the art of security analysis to just a few cold quantitative indicators. Nor does it dismiss the profound value of deep, qualitative, fundamental research, the kind Graham and Dodd championed.
No, definitely not. If anything, it refines the challenge.
Exactly. Instead, it offers a powerful challenge for you to consider. If these fundamental economic factors, so elegantly captured by models like Q5, explain so much of what we once attributed to magic or pure alpha or unquantifiable insight, what truly unique qualitative insights are really left for active managers to exploit? What advantages cannot be captured by these increasingly sophisticated systematic models?
And perhaps more importantly, how can you, the discerning investor, the analytical learner, sharpen your own financial statement analysis? How can you hone your judgment to identify those precise, subtle nuances, those unquantifiable competitive advantages or risks that perhaps even these comprehensive models still can't quite grasp?
It's a call not to simplify, but maybe to refine your understanding, to appreciate both the power of these systematic economic drivers and the enduring potential value of insights that lie beyond them. It's about going even deeper into understanding what truly drives value creation and expected returns.